Lebanon's economic minister estimates that the conflict with Israel has cost between $15 and $20 billion. South Korea's central bank cuts its interest rate by 25 basis points, marking the first back-to-back cuts since 2009. And Germany's annual inflation stabilizes at 2.4% in November, defying expectations of a rise. Welcome to the Economic Bulletin, where we present comprehensive coverage and expert insights on the latest economic trends and developments. Welcome back. We start off in Europe, where European Central Bank President Christine Lagarde suggested that the European Union should prioritize discussions with the United States over potential trade tariffs rather than imposing countermeasures. She reflected on the EU's past approach, emphasizing negotiation over retaliation as a more effective strategy. Lagarde cautioned against the risks of a trade war, advocating for cooperative solutions such as increasing imports from the US to facilitate dialogue. She argued that retaliation could escalate into a harmful tit-for-tat scenario with no clear winners. Lagarde warned that a trade war would likely harm global GDP and suggested they could lead to slight short-term inflationary effects.
TPI. The Governing Council judged that it is appropriate to take...
German annual inflation held steady in November, defying expectations of a second consecutive rise and breaking a downward trend in the country's struggling economy. According to figures from the Federal Statistics Agency, the annual inflation rate in Germany stabilized at 2.4%. Core inflation, excluding food and energy, rose to 3% in November, up from 2.9% the month before. Energy prices dropped by 3.7% year-on-year, while food prices increased by 1.8%, according to data from the Statistics Office. Official data showed that Turkey's trade deficit shrank by 10.5% year-on-year in October to $5.9 billion. Data from the Turkish Statistical Institute showed that exports rose by 3.1% year-on-year in October to $23.5 billion, while imports remained steady at $29.41 billion. The data also revealed that the trade deficit narrowed by 30.1% to $65.8 billion during the January-October period. The European Union Commission has unveiled its autumn economic package, signaling a shift towards tighter fiscal policies in 2025. As part of the new economic governance framework, the EU will implement excessive deficit procedures for its 8 member states due to the elevated public debt and fiscal deficits exacerbated by Russia-Ukraine conflict. These countries must reduce their deficits or face potential fines. The package also highlights a modest growth forecast for the EU, with domestic demand driving recovery amid cooling inflation and strong labor markets. Geopolitical risks and uncertainties remain significant concerns. Public investment is expected to rise in most European Union states. Mexican President Claudia Sheinbaum clarified that her recent discussion with U.S. President-elect Donald Trump did not include specific talks on tariffs. This follows Trump's threat to impose a 25% import tax. During a press conference, she stated that the conversation focused on issues prompting Trump's tariff threats, such as illegal migration and drug trafficking. She also emphasized her strategy aiming to address migration before it reaches the border and highlighted Mexico's commitment to fostering cooperation rather than closing borders. Both leaders agreed to maintain a constructive dialogue moving forward. Russia's central bank announced that it will suspend foreign currency purchases until 2025 to stabilize financial markets after the ruble fell beyond 110 to the dollar, losing one-third of its value since August. The bank, which uses Chinese yuan for interventions due to sanctions, said the move aims to curb market volatility. The ruble was down 7.25% on Wednesday, trading at 113.15 to the dollar, further pressuring inflation at 8% annually. Economic data shows signs of overheating, with real wages up 8.4% year-on-year in September, record low unemployment of 2.3% in October, and weekly inflation near 0.4% despite a 21% benchmark interest rate. Bank of England Deputy Governor Claire Lombardelli has urged caution regarding a potential economic slowdown, citing signs of weaker growth in the UK and other European economies, such as Germany. Lombardelli advocated for a gradual reduction in interest rates and highlighted the uncertainty surrounding economic forecasts ahead of next month's rate decision. The UK's interest rate currently stands at 4.75% following two recent cuts, after a series of hikes aimed at curbing inflation, which has now dropped to the 2% target. Lebanon's economy minister Amin Salim has revealed staggering figures on the economic toll of the ongoing conflict with Israel, estimating losses between $15 and $20 billion. Salim highlighted the devastating impact on key sectors, including agriculture and tourism, which have sustained combined losses exceeding $2 billion. The minister also expressed concern over rising unemployment, which could soar to 70% from an already alarming 50%, as the country struggles with the compounded effects of war and a pre-existing financial crisis. Salim described the challenges as unprecedented, warning that recovery efforts will require substantial international support.
Lebanon, a nation already burdened by economic collapse, now stands amid ruins left by the recent conflict with Israel. Over 3,700 lives have been lost, nearly 16,000 injured, and entire neighborhoods reduced to rubble. Housing damage alone has reached $2.8 billion, displacing nearly 1 million people within the country and forcing over 500,000 to seek refuge. The economy is in free fall. Estimates show that the total war losses are up to $20 billion. Once vital sectors like agriculture and tourism have been decimated, with billions in damages. According to estimates in a World Bank report, damages to agriculture amount to approximately $124 million, while total losses exceed $1.1 billion due to missed harvests caused by the destruction of crops and livestock and the displacement of farmers. The World Bank projects a 5.7% contraction in GDP this year, reversing any hope for recovery. Meanwhile, unemployment 90-day ceasefire deal emerges, one question remains. Can Lebanon find the strength and resources to rebuild, or will this conflict mark a beginning of a deeper economic collapse?
Joining us today from Dubai is Dr. Ali Askar, economic expert, to talk about the economic damage of the Lebanon war. Welcome, Doctor. Now, how has the ongoing conflict directly impacted Lebanon's industrial, agriculture and tourism sectors in terms of losses and disruption?
Well, good evening. Well, first, to understand the Lebanese economy, we'll have to understand how it functions in the first place, because it's somehow, I would say, like somehow distinct and somehow different from different economies that we can see in the region. The Lebanese economy is predominantly service-oriented, with tourism and agriculture playing a critical role. However, the industrial and sort of, I would say, the agricultural within the last couple of years are also suffering considerably because of financial issues and within the financial crisis that we had within the last 2 years.
Now, we know that economies and markets, Doctor, they are perhaps impacted by announcements. Do you think any kind of announcements in the past few days, including the ceasefire agreement, could influence how the Lebanese market could function?
Well, to be honest, it can help in two ways mainly. At least save what can be saved in terms of the agricultural and the missed harvesting. I don't know if there's anything left to be harvested in the first place. Now, in terms of the tourism, we know that there are almost around 1 to 2 million Lebanese expats that are willing to come to Lebanon or visit Lebanon, especially during the holidays or the upcoming holidays. So I think within the next couple of weeks, we will be able to see if we're gonna have some sort of a human influx or some sort of a touristic influx towards Lebanon during the holidays, which might at least add some, or at least increase the stability of the touristic sector, specifically we would call it the family touristic sector.
What are the immediate infrastructure needs for Lebanon's recovery right now?
Well, there hasn't been any proper quantification or exact quantification for what has been lost, specifically in the southern side. What we can tell easily from what we can see from the media or what has been quantified during the last 2 months, I would say roads, infrastructure, telecommunication has been lost, or at least most of the telecom.
Reports have been saying that infrastructure, including the electricity and water, and as you said, telecommunications, they have all been critically impacted by the war and by the shelling of many villages in southern Lebanon.
And don't forget, like actually the chemicals that has been dropped due to the shelling and due to the explosions around, or the chemicals used at least in the war. So I think it might take a lot of time actually to recover, or at least to recover the healthy infrastructure in terms of the water supplies and the sanitization.
Right. Now, there has been talks about international support for the international aid and the regional investments in Lebanon for its economic recovery, especially when we're talking about perhaps the current talks in Beirut today. And what kind of reforms do you think should happen in order to support the economic stability and growth?
Well, to be honest, if I'm trying to quantify how much international aid do we need in terms of how urgent it is, I would say it's like 10 out of 10, in fact. The international aid funding, at least, should be particularly, or should be devoted into the infrastructure and housing, or rebuilding this infrastructure and the housing that was completely lost. The rest can take different stages or different types that can do direct or indirect investments. But in terms of the political reforms or the structural reforms, in terms of the public politics or the public finance or the monetary policies, there should be a lot of reforms, because like as we've seen, even before the war, the issue was reforming the entire structure of the country.
Well, thank you very much, Dr. Ali Askar, economic expert. Thank you for joining us on Qnews and for your insights. The foreign ministers of UK, France and Germany expressed disappointment with Israel's recent decision to extend banking cooperation with Palestinian banks for just 1 month, warning that it endangers the Palestinian economy. In a joint statement issued from Berlin on Thursday, the ministers called on Israel to immediately extend basic interbank correspondence services for at least 1 year as the current deadline approaches on November 30th. The statement emphasized that cross-border payment systems should not be used to undermine the Palestinian Authority. Moving to Asia, South Korea's central bank unexpectedly reduced its benchmark interest rate by 25 basis points, marking the first back-to-back cuts since 2009. The decision follows weaker than expected third-quarter GDP growth of 1.5% year-on-year, below the forecasted 2%. The Bank of Korea also downgraded its 2024 GDP growth outlook to 2.2% from 2.4% and cuts its 2025 forecast to 1.9%, citing slowing exports and economic headwinds. Exports are projected to rise only 2.8% in November, the weakest in 14 months. Meanwhile, inflation eased to 1.3% in October, its lowest since February 2021.
금리를 현재의 3.25%에서 3%로 인하하기로 결정.
China's Commerce Ministry responded to U.S. President-elect Donald Trump's threat to impose tariffs on Chinese goods, stating that arbitrary tariffs will not resolve domestic issues. In the U.S. spokesperson, he also emphasized China's consistent position and urged the U.S. to adhere to World Trade Organization rules. Trump, set to take office on January 20, 2025, announced on November 25 that he would impose a 10% tariff on Chinese imports, pressuring Beijing to take action against chemicals contributing to the opioid crisis in the U.S. During his first term, trade tensions saw corporate leaders and investors closely monitoring Chinese state media for indications of U.S. companies that might face penalties or benefit from the trade war. JP Morgan economists warn that China could allow its yuan to depreciate by 10 to 15% in response to higher tariffs under President-elect Trump. The bank predicts a 60% effective tariff on Chinese imports, up from 20%, which could slow China's 2025 growth to 3.9% from 4.8%, while the yuan has already dropped 1.4% since Trump's re-election. JP Morgan notes that a larger depreciation is unlikely due to financial stability concerns. The broader trade shock is expected to slow emerging markets growth to 3.4% in 2025. According to the National Bureau of Statistics, China's major industrial enterprises recorded a 4.3% year-on-year decline in combined profits during the January-October period. Enterprises with annual main businesses revenues of at least 20 million yuan achieved total profits exceeding 5.86 trillion yuan. Their business revenue increased by 1.9% year-on-year, reaching 110.96 trillion yuan. In October alone, profits narrowed with a 10% decline compared to the same month in 2023. Brazilian President Luiz Inácio Lula da Silva has expressed optimism about finalizing the long-delayed EU-Mercosur trade deal by year-end, despite resistance from France. Speaking at an industry event in Brasilia, Lula emphasized that negotiations were advancing with European Commission President Ursula von der Leyen, who has the authority to finalize the agreement. The deal under discussion for 25 years links the EU with the Mercosur nations.
E a Ursula von der Leyen tem procuração para fazer o acordo e eu pretendo assinar esse acordo este ano ainda. Isso acontece com o presidente do SESI.
Brazil's finance minister has announced a plan to cut $11.8 billion from public spending by 2026. The measures include limiting minimum salary growth, capping high public sector salaries, and raising taxes on incomes over 50,000 reais. Wages up to 5,000 will be exempted from income tax. He also emphasized fiscal sustainability and combating inflation as key goals. The plan comes amid investor concerns over rising spending under President Lula's government and market fears of higher interest rates to curb inflation. New Zealand's central bank has cut its cash rate by 50 basis points to 4.25%, marking its third reduction in 4 months, with more easing like in February. The Reserve Bank of New Zealand Governor Adrian Orr said the decision aligned with inflation nearing the bank's target and hinted at another 50-point cut next year. At a news conference, Governor Adrian Orr noted that even with the 50 basis point cut, the monetary policy stance remains somewhat restrictive. In the energy sector, the OPEC Plus alliance has postponed its weekend meeting to December 5, citing scheduling conflicts with the Gulf Summit in Kuwait City. The group, led by Saudi Arabia and Russia, was set to finalize its 2025 output policy. An OPEC spokesman said that the December meeting will be held online. Oil prices ticked up after the announcement of OPEC Plus meeting's postponement on output policy to December 5. Brent crude futures edged by 0.4% to 73.10 cents a barrel. U.S. West Texas Intermediate crude futures were up 0.3% at $68.95. Gold prices increased following U.S. inflation data that strengthened expectations of a Federal Reserve rate cut next month. Spot gold was up 0.4% to $2,645.41 per ounce. U.S. gold futures rose 0.2% to $2,644.70. And that's it for now. Here's a roundup of our key headlines. Lebanon's economy minister estimates the conflict with Israel has cost between $15 and $20 billion. South Korea's central bank cuts its interest rate by 25 basis points, marking the first back-to-back cuts since 2009. Germany's annual inflation stabilized at 2.4% in November, defying expectations of a rise. Stay connected for more news and updates on Qnews.